is Bloomberg Surveillance, Early Edition, with Francine Lacqua.
Good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London, and here's what's coming up on today's program. CPI tailwinds. European stocks edge higher after yesterday's U.S. inflation print fuels optimism that the Fed will downshift to smaller rate hikes. Decaying demand while Chinese exports fall for the third straight month as slumping global trade weighs on economic prospects. Plus, President Biden's handling of classified documents erupts into a political crisis with a special counsel appointed to investigate. So we'll have, of course, all of those top stories for you, but let's check in on the markets. Now, we're actually seeing a rally across the board. Certainly, global stocks set for a weekly advance after that inflation print from the U.S. yesterday. European stock also edging higher, set for their strongest performance in about 2 weeks. U.S. equity futures pretty much falling, but really unchanged. The U.S. 10-year yield 3.4284. And in terms of big market moves, I would really point to what we're seeing with yen currently at 128.29. And if you look at that 10-year bond yield in Japan, actually spiking above the 0.5% ceiling. And there's more and more speculation that the BOJ will actually review the side effects of its ultra-loose monetary policy. So quickly, let's get onto the European map to see if there are any huge differences between the various countries. The DAX unchanged, the CAC, and of course, the FTSE 100 in the UK gaining 0.5%. So the Fed likely to shift to smaller hikes after U.S. inflation cooled in December. That's the very latest from that. So let me tell you what else is going on. When we look at the Fed and when we look at exactly some of the things that we want to know about is what several policy members are saying. So let's get straight to our guest, and Christine Aquino is with us. Christine, when you look at the markets and when you look at exactly one of the main turbulence that we're seeing with how markets are interpreting what Fed officials are saying, are we going to see more aggressive and much more aggressive stance from Fed officials?
Based on the market's interpretation, that's not going to be the case moving forward. I think markets are very much trying to make sense of what the Fed's going to be doing moving forward. And I think their conclusion is that yesterday's inflation print, the fact that it is continuously cooling, will give the Fed room to at the very least, slow down its pace of rate hikes. I know that some people, particularly those who are quite bullish on risk assets, are hoping that this could actually pave the way for the Fed to start pivoting and reconsider rate cuts. Personally, I think we're a little bit far off from that, but that's certainly the direction of travel that we're seeing.
Christine, thank you. Let's also bring in Baylee Wakefield, multi-asset portfolio manager at Aviva Investors. Baylee, thank you for joining us. It's been quite a big week in terms of what equity markets are doing across the board. Are you positive, Baylee, that this will continue going forward, that we're going to have positive and encouraging news?
Well, it's definitely encouraging from the start, but there's still about 3 weeks to go until the Fed's next rate decision. We knew if we got a clear read in one way or other in yesterday's report, it probably would have been decisive. There are other indicators coming up, of course, and the market is trying to work out which of these is going to be the decider, which is why we're seeing so much scrutiny around each data release and that increase in volatility. Initially, it was quite hard to say whether this report decisively argued for 25 bits or 50. And although we can't claim victory too quickly, it does provide further evidence that we have seen peak inflation in the US. Attention, of course, is now going to turn to the Fed speakers to confirm the market's expectations. As we've seen, some categories that have pushed inflation higher over the past year have started to come down, such as energy, but services pricing is still going up, which is a lot stickier. And that core services area is something that Powell was calling attention to last month. But initially, we did see some disappointment in markets because there was probably more expectation of a more benign inflation environment. So being bang on forecast initially was more of a disappointment. And also jobless numbers are coming in slightly lower than forecast. And excuse me, that underscores that the job market remains pretty tight. But then as the market digested more of that detail and incorporated some of the speaker's comments, we saw more confidence. And overall, the market has cautiously welcomed the data and sees that increased possibility of a soft landing.
Christine, when you look at some of the data, out there, so we started talking about the Fed, and of course Baylee was explaining exactly what the market's looking at. Are we underestimating or overestimating the fear factors? I mean, if we have a recession, even if we have a long protracted recession, this has been the most telegraphed recession probably in the history of recessions. What does that mean for certain asset classes?
Well, Francine, yeah, I think in terms of the risk factors, there's still plenty out there. Just looking at the data yesterday, there is still quite the discrepancy between goods inflation, which has come down quite a bit, and that is the good news, and services inflation, which really is looking quite sticky at this point. And so I think the risk there, particularly for those who are more bullish in asset classes, is that there needs to be a more, pronounced slowdown, particularly in the jobs market, right? And that usually hits home a lot harder for households and something that tends to cause a lot more pain. And so for risk assets, I think this is the danger, that we are underestimating that potential real economy impact that could flow through via job losses primarily. We haven't really seen that. We haven't really seen a wave of companies having to cut massive jobs spreading beyond certain industries, such as tech and perhaps some of the banking industry. That's kind of par for the course. But if we start seeing that spreading more widely, then that's definitely something that could give bulls a bit of pause.
Baylee, what's your take on dollar? Is this I don't know what is one thing apart from inflation that you have to get right, but is dollar going to weaken from here?
Well, what we've seen so far is that the dollar has had quite a volatile start to the year. We think that we might have seen the peak in the dollar. And of course, as we've seen different data releases come out over the past week, we've seen the dollar move in both directions. But, we have seen some more weakening over the past couple of days. And we think that if that end of hiking is in sight, that means that the dollar is going to suffer, and we have seen that peak.
Christine, when we have data points, I mean, we're having earnings. If you look at a lot of the banks, so we're looking at cost cutting. Is this the year where, we're going to see just a lot of cost cutting and so margins being squeezed because they're trying, and this is all sectors across the board, trying to hold on to their market share?
Yeah, and that's definitely the flavor of this earnings season, Francine. Just any indication of companies trying to cut those costs, particularly in the labor market. And I think this is why, in particular, that inflation in the services sector of the U.S. economy is quite important to take note of, because, the job market is very much at the center of that. And the fact that we're seeing still, in terms of the data, a robust job market, but then indications from companies during earnings season that no, they're going to start cutting all of these positions and rethinking some of their hiring moving forward. That's quite the discrepancy, right? And that's potentially something that's yet to be priced into markets. And investors have yet to fully realize the real economy impact of that.
All right. Thank you both for joining us. Christine Aquino, they're a managing editor for City Latest, and Baylee Wakefield, multi-asset portfolio manager at Aviva Investors, stays with us. Coming up, U.S. banks set for another quarter of bumper profits, but is the windfall nearing its peak? We preview the earnings report next. And this is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, it's a big day for the big banks, as a number of major U.S. lenders are due to report earnings in the coming hours. J.P. Morgan, Bank of America, and Citi are amongst them. Now, for more on all of this, we're joined by Bloomberg finance reporter Tom Metcalf. He also oversees, more than a reporter, he's a reporter, and he oversees all of our coverage for EMEA. Tom, thank you so much for coming on. So we look at a lot of the U.S. earnings, and I guess there's a general theme of, little bonuses, cost cuts. Like, what are you looking out for?
Yeah, definitely. All those things. Also expecting, how do they trade in Q4? But I think probably the big picture here is everyone's really now focused on the outlook. So it might be a really strong quarter for some of these banks, but people are kind of now a bit more worried about their shadow with these, possibility of recession. And that obviously then will really hit the banks hard. So I think today, especially, you'll be looking for How is Citi kind of guiding on loan losses, for example?
Yeah. So we've talked about this, before for especially UK banks, that they've just hired too much, and now we're seeing a downturn. So is it that, again, a lot of these US banks, are they predicting recession, an ugly recession, or that they just got too big?
I think it's probably more of the latter, actually. It was a real boom time the last couple of years for hiring. Goldman, I think, have grown by something like 30%. So inevitably, these job cuts are going to be painful. But when you put it against the context of, Goldman 2-3 years ago, it's sort of a bit of a blip rather than a huge change.
Tom, what are you expecting for Europe? And we had one of our guests saying, look, maybe there are opportunities in Europe because when you look at price-to-book ratios and things like that, they're just so much weaker. And now we're seeing the titans of Wall Street also struggling.
Yeah, exactly. It could potentially be a good time for European banks. I mean, relatively, right? Because this net interest margins, they'll be getting fatter and fatter, you'd expect. Finally, they're coming out of this low-rate environment. So in a way, they're sort of got a bit of catch-up to do with the US banks. But, you look back over the last few years and that sort of valuation gap has been pretty permanent. So whether that can shrink that much, I'm not sure. OK, that's
a good point. Also, Tom was on a great podcast with me and Dave Mayer where he explains that bonuses are going to be really tough. And he basically told everyone, if you're a banker, just go work for a hedge fund instead. So listen to that podcast with Tom Metcalf. Thank you. Now we're back with Baylee Wakefield, multi-asset portfolio manager at Aviva Investors. Baylee, we're getting into the earnings season. It's going to be 5, 6, 10 companies a day with earnings. What are you looking out for?
Well, overall, when it comes to strategy for 2023, we think it's really important to be clear on what questions need answering. And of course, we're going to find out more and more of that data as we go through earnings season. But for us, earnings is one of those key questions that we need to find an answer to. So in 2022, broadly, earnings were pointing towards fragility rather than collapse. And now we need to see whether that is still the case. Last year, earnings were more optimistic. Now we are seeing some rectifications on what the sell side predictions on earnings are coming down slightly. It's clear that now that markets are also expecting earnings to come down, but we need to gauge what level of losses are going to be tolerated by the market. So we can see a scenario where even up to a 10% loss could be tolerated by markets, but what about 20%, 30%? That scenario could be something that the market isn't expecting.
So, Baylee, how do you game theory this? I mean, are you expecting overall equities to be higher on the year with a pickup in the second half, or do you front load maybe some of the equity buys because it'll be better than expected in terms of earnings, but then could deteriorate into year end?
Yeah, I think we're more on the side of going with a more earnings resilience theme at the moment. We can see a little bit of weakness in the first half of this year. So that's why we favour more of those areas of the market that are a little bit more resilient. So one position that we continue to have conviction in is the US healthcare sector, which outperformed versus the S&P 500 by almost 20% last year. Of course, some of that was led by the defensive nature of the sector, which we expect to continue, and that earnings resilience that the sector provides in volatile environments. But that more idiosyncratic nature of the trade was also a benefit. Demographic trends remain to be supportive of the trade with aging populations, but we've seen accelerated innovation post-COVID-19.
Baylee, are we underestimating actually the impact of COVID-19 on the future for the next couple of years? So we're in a higher interest rate environment. That could be a new normal for quite some time, which the markets haven't 100% figured out, but we're still having COVID legacies.
Yeah, I think so. And it's a particularly interesting case with China. And of course, we're seeing them come out of their zero COVID policy. And I think it's going to be particularly interesting to see what the new normal for China actually looks like. In the West, we've gone back into a scenario where we'll have more working from home as well as going into the office or going into whatever industry that we work in. But we need to see what the new normal is going to look like in different places to be able to see what we're going to expect going into future years.
Baylee, thanks so much. Baylee Wakefield, their multi-asset portfolio manager at Aviva Investors. Coming up, the UK economy unexpectedly grew in November. More on the latest GDP figures up next. And this is Bloomberg.
next week. Bloomberg is live at the World Economic Forum annual meeting in Davos, Switzerland. As energy crises loom, wealth inequality intensifies, and global power dynamics dominate headlines. Trust Bloomberg for the fastest coverage and exclusive analysis from the world's top leaders and experts. Coverage begins next week, only on Bloomberg Television and Radio.
Well, good morning, everyone, and welcome to our daily Bloomberg UK segment. We focus on the biggest challenges facing the British government, economy, financial services, and markets. And I'm Francine Lacqua here in London. Now, UK GDP unexpectedly rose 0.1% in November as consumers kept spending through the worst cost of living squeeze in memory. Now, economists had expected a small decline for the month after growth in October. Well, joining us now is Philip Aldrich. He's Bloomberg's senior UK economics reporter. Phil, thank you so much for joining us. Now, just talk to me a little bit about the GDP number, because we were either underestimating the resilience of the UK economy, or this is just football spending, right? There was a World Cup and people wanted to host.
It's more the former. It's more the resilience, because so football gave and took away at the same time. People went down the pubs, spent more. It was a net contributor. They spent more in the pubs watching the games, but they were playing less in the sports pitches. So you had this decline in sports activities. But overall, it was the services sector that boosted growth, and so there was administration. There was recruiters were really busy, according to the ONS. So there was some genuinely positive underlying signs of some level of resilience in the service side of the economy, which is the one where people are most worried about.
So overall, we're like January, what is it, like 13th? I mean, we forget the times because we're both going to Davos. Certainly I forgot, the dates. What does it mean in terms of what BOE does? We also heard from Catherine Mann saying, look, interest rates have to go higher. Yeah,
if anything, it's going to reinforce the sort of need to continue to raise rates relatively aggressively narrative, because the Bank of England was forecasting, is forecasting a recession for the final quarter of this year. It now looks like for the UK to actually dip into contraction in the final 3 months of 2022. Sorry, talking about last year. That we'll need to have seen a 0.5% contraction in the final month, in December. And actually, there's been a lot of really positive news coming out of the retailers. You've had Next upgrading its profit outlook. There's been good numbers from Tesco's and other high street chains. People have been, Ryanair and others have been talked about people buying flights and holidays. So it doesn't look like there's going to be an awfully terrible December number, so we will have skipped that recession, which basically will put more pressure on the bank to, worry about the inflation pressures within the economy, the spending pressures within the economy.
But are you more optimistic about the future? Because you could also say, because of the overhang of, the COVID, basically on lockdown, people wanted to spend, and then it's this year, maybe middle of the year, when you have mortgages that are no longer fixed rate and people start losing their job, that it's crunch time.
Yeah, so it's probably, as I think people are saying, it's recession delayed rather than recession averted. But the question, I think, for most people is, like, if we do have a dip, let's say, how severe is the dip? And there is no question that households are feeling a living standard squeeze. That is actively happening. Obviously, wages are not keeping up with inflation and prices are rising aggressively, etc. So that story continues. So it'll feel bad. It's going to feel like recession. But there is resilience in the economy. We have unemployment still at extraordinarily low levels, and as you say, households have got this built-up savings. So there's positive things to take away at the moment.
We're both going to Davos, and I find it quite strange. So there's no chancellor, there's no prime minister, but actually the Labour shadow chancellor and the Labour shadow PM are going to be there, Keir Starmer. So are they trying to attract international investment? Are they trying to be seen as business friendly?
I think it's interesting because obviously there's this sort of elitist streak of Davos which sort of rubs some people up the wrong way, and so the Rishi Sunak and the government do not want to be associated with that. I mean, he's already a billionaire, so it's not something he needs to reinforce. Whereas the other side of Davos is that you do build up relations, you find potential institutional investors into the UK, and most importantly for Labour is that they need to build up their business credibility, which they have been doing quite successfully. And as a government in waiting, visiting Davos and showing that you're on the world stage is definitely a good thing. And so I think they definitely seem to be seizing that opportunity as the government kind of steps away from that scene.
Yeah, really interesting dynamics. Philip, thank you so much. Philip Aldrich there with the very latest on the UK. And we'll also be covering all things UK every week on Thursdays at 9:30 a.m. in our half-an-hour special. And next week, we actually have a Davos, maybe UK special. Let's get straight to the Bloomberg First Word News. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. Sam Bankman-Fried has used a blog post to deny stealing from his now bankrupt crypto exchange. The FTX founder offered one of his most detailed descriptions yet of the company's collapse as he prepares to fight fraud charges, blaming crashing markets and an attack from a rival exchange. The 30-year-old says he regrets being slow to respond to public mispreconceptions. The Chinese government is set to take so-called golden shares in units of tech giants Alibaba and Tencent. According to a corporate database, Beijing bought 1% of an Alibaba digital media subsidiary. That was last month. The share structure could grant the government officials influence over the industry, including the power to nominate directors. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg. Francine.
Thank you so much, Leanne. Coming up, a non-resident senior fellow in the Atlantic Council, Kidremas Ginglaukas on Ukraine. CPI tailwinds, European stocks follow Wall Street higher after yesterday's U.S. inflation print fuels optimism that the Fed will downshift to smaller rate hikes. Decaying demand while Chinese exports fall for the third straight month as slumping global trade weighs on economic prospects. Plus, President Biden's handling of classified documents erupts into a political crisis with a special counsel appointed to investigate. Well, good morning, everyone. Welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, while the war on the ground in Ukraine grinds on and the outcome really remains uncertain, many in Western capitals are beginning to consider what the European landscape will look like post-war. Now, we're now joined by non-resident senior fellow at the Atlantic Council, Kidremas Ginglaukas. He's also former Assistant Secretary General for Executive Management at NATO. So thank you so much for joining us. You were at NATO for a long time, so you've seen things. You understand strategy. How long could this war continue for?
Francine, actually, it's anyone's guess. The situation is uncertain. The war is by nature very uncertain. But I think what we have seen is that there are two determinants. One is the Ukrainians' will to fight, to persevere, which we have seen actually extremely well. We see galvanizing leadership by President Zelensky. We see the perseverance of Ukrainian people. We see the resilience of institutions. Now, I think on the other side, it's about the West, about the NATO. And what we've seen also in this past 10 months, I think, is the strengthening of both NATO and, I would argue, EU as institutions that remain relevant in this world. The support is flowing. The public support remains high. I think we're no longer talking about not sending non-lethal weapons, lethal weapons or so. It's really about supporting Ukraine as much as possible.
But is this good or bad in the eyes of, I mean, it's very clear actually that in the eyes of Vladimir Putin, this is bad, right? So he feels threatened. So what does it mean for world peace? It's good to have allies that are strong, but does it put him closer to nuclear deterrent? Now,
I think the world, one thing that's very clear is the world has changed, and we see both from NATO's side, is that it's very clear. We live in an era of strategic political competition. So we see the dividing line, which is values. This is democracies versus autocracies. So I think this fight is good because, again, the world is fragmenting along these lines, along democracies and autocracies. Now, if we look at 10 years ago, we're thinking about the China and Asia, the world economy engines of the world. Now we saw President Biden several months ago talking about, well, this century will be defined by the battle of democracies versus autocracies. So I think it's a different world. I think the West is coming together. NATO is coming together. NATO plays an essential role in really galvanizing that support in the West. And I think we're I think it is good. It is absolutely positive for the future of peace.
I was told by a senior diplomat that actually on February 24th last year, when there was, of course, Russia invaded Ukraine, the thing that Europe or the thing that NATO or the thing that the US should have done is fly directly to Beijing to get them on side. What's China's role in this?
Well, I think China also chooses what it can do. I think it has chosen to support President Putin. It was right before the invasion. They announced this limitless friendship. I think again the world is, as I mentioned, fragmenting. I think it's the dividing line is democracies. NATO, EU, of course, led by United States, stands on one side. I think China's growth, China's military saber rattling, what's happening around Taiwan, the sort of unlimited defense spending, the sort of unchecked nuclear exercises, it tells you that they are on the other side. So I think we're clearly emerging into that kind of divide.
What surprised you the most in the last 12 months? Is it the fact that actually there's a resolve in the West to stick together and the amount of weapons that were sent to Ukraine, or is it something else?
I think the perseverance of Ukraine and being able to adapt the society, the leadership by Zelensky, which nobody could have thought that he would be such a galvanizing, such a motivating figure, not just inside Ukraine, but also really rallying democracies for this. I think it is bringing that clarity. And to me, if we look at 12 months ago, what the consensus at NATO was, do we need to talk? Maybe we need to talk to Russia. Maybe we need to support Ukraine or not. There's no longer that exists. It's really that clarity that is in 10 months has been brought upon by this war and by actually Ukrainian support, Ukrainian perseverance, as well as Western unity, which yields that support that's needed. I think this is surprising if you tell me versus 10 months ago, but also a very welcome development.
Do you think this will hold? Will these coalitions hold? I know we're both going to Davos, and the theme is cooperating in a fragmented world. I mean, a lot of these themes are difficult to really understand. This one's quite clear. It's the West has to hold as a bloc.
It has to hold. That's right. But I think the two things is that NATO has made itself relevant. The European Union has made itself relevant. Now NATO has refound the mission. The Eastern Front is more stronger than ever before. The two new members are joining NATO. Fingers crossed by the middle of the year. I think we are in a good position. EU, the 9 rounds of sanctions. I think it shows that EU, which is such a fragmented organization, yet with such incredible legislative power, has delivered with the sanctions. It has offered Ukraine the membership plan, which is, again, it tells you that its leadership, the consensus is there, the support is there. Yes, on a ground level, there's all sorts of disagreement and how to do it tactically, operationally, but on a strategic level, I think we're very in a proper situation.
Should we take the threat from Vladimir Putin of nuclear war seriously? So what does that mean for NATO? Do they need to position their troops differently across the border?
I think it's important to take any threat serious. I think it's important. I think obviously it's a nuclear state, but we've seen it before. Russia, or before that, Soviet Union has always played the nuclear card in such a manner. I think the rhetoric that President Putin is now putting out is truly irresponsible, and I think the Secretary General of NATO has been very clear about it. I think President Biden and National Security Advisor Jake Sullivan have been clear. Anything that if Russia chooses this path, it's very clear that it is suicidal for the regime. It's destructive for Russia. So, we have to take it seriously, but we also have to be clear-minded that this is not good for anybody, neither, and for Russia as well.
What would happen after Putin if there's, I don't know whether there is a belief and whether that's 5%, 6% of regime change in Russia?
I think it's hard to predict. There really at the moment, there are no opposition forces able probably to challenge President Putin. I think but at the end of the day, this fight for him in Ukraine is important, and he wants to deliver some sort of victory. And that's why I think for us, for the West, we need to stay on the message, stay on the path, support Ukraine, and see what happens. Really, the change in such a big country like Russia can only happen internally. And it's really up to the Russian people also to see what can be done and how to move forward with this regime or offer a new regime. Again, if a new regime comes into place through whatever means, through a method, it doesn't mean it's going to get better. It could be even more hardliners can step up. So, we have to do what we have to do, is support Ukraine, stay united, and I think as democracies we have a clear future for prosperity and peace.
Thank you so much for joining us. Jidremas Janklitskas, their non-resident senior fellow at the Atlantic Council, former of NATO. Now, coming up, more pressure on the U.S. president. That's as a probe widens into the classified documents found in Joe Biden's garage. That's coming up next, and this is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, Chinese exports fell by nearly 10% in dollar terms in December. That's as global demand continued to drop off. Now, Beijing is warning that foreign trade will still face pressures in 2023. Now, for more, we're joined by Bloomberg's Enda Kern in Hong Kong. Enda, good morning. Good afternoon, actually, for you. What are the key takeaways from this trade data?
Very weak trade numbers out of China, Francine, as you mentioned, almost down 10% in the month, speaking to the idea that the great merchandise trade boom, which was a pillar of China's economic growth throughout the pandemic, really has now come to something of an end. It's true that some of the disruption from COVID, the end of COVID zero and the lead up to that is probably part of this story as well, but nonetheless, it's a fairly soggy story. Chinese imports also weak, down 7.5%. That doesn't bode well for a regional demand, given how China's reliance on raw materials and resources from other countries. Nonetheless, though, these figures are a little bit backward looking. Going forward, the story is meant to be about perhaps a global economy avoiding a worst case scenario, and China itself, of course, getting back on its feet post-COVID zero. So the question becomes is whether or not this is the trough for China's trade slump or whether there's still a worse ahead.
So, Enda, switching gears a little bit, an arm of the Chinese government is also set to take shares in Alibaba and Tencent. What does this move by the government mean?
So they're taking small stints, I think, of around about 1% stakes in these companies, Alibaba and Tencent. Francine, on paper, of course, it speaks to the idea that the party is in control. It's all about influence. It's all about ensuring that they're at the top of these companies and having a say in where they're going, China's strategic interests. But though some analysts were making the point that these stakes are pretty small overall, and actually it does seem like the worst of China's tech regulatory crackdown is now behind the country, which is perhaps speaks well for maybe broader stability. We've certainly seen plenty of policy pivots in recent weeks. We, of course, have had moves to shore up the real estate sector. We had that dramatic move, obviously, on COVID zero. Now some people are saying that they think this is a signal that perhaps a tech crackdown is also nearing an end, that the government has come from to let these companies move on a bit. So I think the broader takeaway is, yes, of course, Chinese party exerting their influence, but some people saying perhaps the worst of that crackdown might now be over.
Enda, thank you so much. Enda Kern there with the very latest on China. He's in Hong Kong. Now let's get straight to a Bloomberg Business Flash. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. Bloomberg has learned that prolific criminal hackers were behind a recent cyber attack on the UK's Royal Mail. A ransomware gang known as Lockbit targeted the company and used encryption to lock some of its computers, rendering them inoperable. The attack shut down the Royal Mail's ability to send international letters and also parcels. Now, Google and Nvidia are said to have expressed concerns to the US Federal Trade Commission about Microsoft's acquisition of video game publisher Activision Blizzard. Bloomberg sources say they have joined Sony in raising competition issues, adding fuel to the government's case against a $69 billion deal. Microsoft has said that Sony's concerns are self-serving. Shares in Uniqlo owner Fast Retailing fell the most in 8 months as COVID weighs on demand in the Chinese market. The Japanese company reported operating profits for the most recent 3 months that did miss estimates. It says it expects sales to return to normal by next month after Beijing's easing of pandemic restrictions. And Vodafone is reported to be planning to cut several hundred jobs, most of which are located at its headquarters here in London. According to the Financial Times, the mobile giant is making the move in an effort to rein in costs. About 9% of Vodafone's 104,000 staff are based here in the UK. And that's your Bloomberg Business Flash. Francine.
Leanne, thanks so much. Now, President Biden is facing greater political pressure after more classified White House documents were found at his private residence. Well, the discovery spurred Attorney General Merrick Garland to appoint a special counsel to investigate the incident. Now, for more on all of this, let's bring in Bloomberg's Bruce Einhorn. Bruce, good evening. What consequences could Biden face politically and legally as a result of this inquiry?
Well, with the appointment of the special counsel, there is now an investigator who has more leeway to go wherever he sees things going, right? The whole point of a special counsel is that they're outside of the sort of regular order of the Department of Justice. So it is a bit of a wild card. Attorney General Merrick Garland has appointed Robert Hur, who was a former official in the Trump administration's Department of Justice and then was the U.S. Attorney for the state of Maryland. There are a fair number of unanswered questions. How did these documents get there? What level of confidentiality are they? Why did it take so long for us to find out that these documents, which were originally found in November, why are we only finding out about it now?
Yeah, and are there parallels actually to what happened with President Trump, or is it just a different story?
Well, I mean, it's similar, of course, in that we're dealing with confidential documents that are in places where they're not supposed to be. So, yes, that there are definitely commonalities here. There are some significant differences, of course. We're talking about what seems to be a small number of documents. That's what the White House is saying, as opposed to quite a large number of documents that were found at Mar-a-Lago. The other big difference is that from what we've heard so far, when these documents were discovered, the Biden administration turned them over right away. That's a big difference from what former President Trump did. In some ways, the big problem that former President Trump has is not that he had the documents, is that what he did with them once the government asked for them to be returned. And so that's where the key difference is that in the case of former President Trump, he didn't return all the documents, and that then led to the special counsel in his case. So we have two different special counsels.
Bruce, thank you so much. Bruce Einhorn there with the very latest on the U.S. We will talk about this story, I feel, for a pretty long time. Coming up, stuck with risky debt, could Wall Street be facing the fallout of driving a flurry of mega deals during the cheap money era? We'll have plenty more on that next on our Big Take. This is Bloomberg.
Next week, Bloomberg is live at the World Economic Forum annual meeting in Davos, Switzerland. As energy crises loom, wealth inequality intensifies, and global power dynamics dominate headlines. Trust Bloomberg for the fastest coverage and exclusive analysis from the world's top leaders and experts. Coverage begins next week, only on Bloomberg Television and Radio.
We got an inflation report exactly as we expected.
Very much in line with expectations.
Inflation has clearly peaked.
Inflation peaked.
Inflation is coming down.
But I think the Fed's going to say we're not done.
They will not be looking to pivot, or they won't be looking to slow down the rate hikes.
They are going to be really reluctant to, I would even argue, stop hiking, let alone start to cut rates.
The Fed has a clear path towards 25 basis points going forward.
Our call is 5.5 for that terminal rate.
But I think the narrative and the attention should turn to how far down are we going to go, not has inflation peaked.
Today is the day that inflation jumps the shark in terms of its importance on the market.
Some of our guests reacting to the latest inflation data from the U.S. Now let's get straight to the Bloomberg First Word News. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. Sam Bankman-Fried has used a blog post to deny stealing from his now bankrupt crypto exchange. The FTX founder offered one of his most detailed descriptions yet of the company's collapse as he prepares to fight fraud charges, blaming crashing markets and an attack from a rival exchange. The 30-year-old says he regrets being slow to respond respond to public mispreconceptions. The Chinese government is set to take so-called golden shares in units of tech giants Alibaba and also Tencent. According to a corporate database, Beijing bought 1% of an Alibaba digital media subsidiary. That was last month. The share structure could grant government officials influence over the industry, including the power to nominate directors. And the only child of Elvis Presley has died. Lisa Marie Presley had been rushed to a hospital in an LA suburb after suffering a cardiac arrest. She released 3 albums with a 2003 debut record, selling hundreds of thousands of copies. She was 54 years old. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg. Francine.
Leanne, thank you so much. Now, several major U.S. banks are due to report earnings today, but how many of them are stuck with billions of dollars of risky debt from M&A deals underwritten in the cheap money era? Now, for more on today's Big Take, we're joined by Bloomberg's Lisa Lee, who's one of the authors. Lisa, first of all, congratulations on a great piece. We pushed it on social media. You can also find it on, of course, the Bloomberg.com and the terminal. And it's basically the fact that this, leveraged debt machine is breaking down because of the current environment. So what exactly is causing the problem for banks?
So what happened is that they promised LBO financing early 2022, even late 2021, that they just haven't been able to sell because investors are asking for higher yield than what they thought they could get. So they sold as much as they could, but they're still left with about $40 billion. And now this $40 billion is not all concentrated equally. Some banks have more exposure than others. For example, Bank of America, which is reporting today, has some of the biggest exposures. JPM has some of the smallest.
So was this mistakes? I mean, is it the change of environment, or was this, they took wrong bets?
Well, when you think about when they underwrote these, inflation was already high. The Fed was saying they were going to raise rates, but they leaned in. I don't think they thought inflation was going to be as persistent and as high as it was, or that the Federal Reserve would be as firm as it would to tighten it and rein in prices. So but some of them, like for instance, Twitter, which is 12.5 billion. It's
so surprising, right?
Yes,
I asked you what surprised you the most. Talk to me about Twitter.
So Twitter was inked after Ukraine, after inflation. There was a real thought that Musk could really turn around Twitter. Yeah. And so that debt is sitting on banks' balance sheets, mostly on Morgan Stanley, Bank of America, and Barclays. And so we'll see how the banks account for that. But by our reasonable analysis and with reporting from the streets, there could be about $4 billion of losses, mark to market. It was unrealized. They haven't sold it. That's a lot.
It's not something we can ignore.
No, we can't. Because that's $1 billion just for Morgan Stanley if that analysis holds. Now, it's really difficult to value Twitter debt. Yeah. Because there's no other company sort of like it in the world right now, but they will have to account for it one way or the other.
Yes, and also, I guess hindsight is a beautiful thing, so maybe we're being too harsh on certain counts. But so who's been underwriting some of that? Is it, I know there's a story about JP Morgan and technology.
Yes, but that's, this is not, the technology one is not a debt story. Yeah. So they purchased themselves a financial aid college online. And now it's not a very big purchase. $175 million is very small for JP Morgan. It's less than half of 1% of their earnings. Yeah. But it just raises questions about their due diligence and their expansion into fintech.
Lisa, thank you so much, as always, for joining us. Lisa Lee there. Now, Bloomberg Surveillance Early Edition continues in the next hour with Matt Miller, Kailey Leinz in New York, Anna Edwards in London. And I'll see you next week from Davos. This is Bloomberg.
The Fed knows that they have more work to do, and they'll do maybe another few tightenings before it's over.
The Fed is going to have to maintain rates at high enough levels to make sure that inflation is moving down.
It just makes sense to steer more deliberately. as we work to bring inflation down.
This is Bloomberg Surveillance, Early Edition with Anna Edwards, Matt Miller, and Kailey Leinz.
It's 10 a.m. in London, 5 a.m. in New York, and 6 p.m. in Hong Kong. Our top stories today. The UK may avoid a recession for now. Gross national product unexpectedly rose 0.1% in November. Apple CEO Tim Cook gets a huge pay cut, partly because of his own request. He'll still make $49 million this year. And big banks dominate today's earnings reports. We will hear from JP Morgan, Bank of America, Wells Fargo, and Citigroup. Welcome to Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller and Kailey Leinz in New York. And Kailey will certainly pivot towards focusing on the bank earnings story as we get through this program and as we get through this trading day. Yesterday, the CPI print, well, that was exciting for a little while, wasn't it? And the Fed comments, perhaps arguably outweighing the details in the data.
Yeah, the data, frankly, came in smack in line with estimates, so there was absolutely no surprise. Perhaps what may have been a bit more surprising was how quickly the rhetoric from the Fed seemed to have changed, kind of playing down the idea that they are going to continue at the same pace they have been for the duration of the last, say, year and change. That is something that Asian equity markets continued to weigh overnight. It broadly was an up day. The MSCI Asia Pacific Index, actually, with a more than 1% rally today, is now at its highest level since June. And what is so interesting is you even saw gains among Chinese technology stocks, despite the fact that there was reports that China is looking to take so-called golden shares in the local units of Alibaba and Tencent, which would in theory give the government more control in that sector. But it actually may be being seen as a mild positive because those shares in both stocks rose overnight. Alibaba up about 1.7%, Tencent by 2%. We'll have more analysis on that story in just a couple of minutes. But outside of the equity market, in the bond market, what is fascinating to me is what is going on in Japan. Bond traders really seem to be pushing back against the BOJ, betting on the idea that the BOJ is going to have to assess the effects of its easy monetary policy and perhaps have to make a total U-turn on yield curve control, because we know the 10-year JGB yield is supposed to be capped at 50 basis points. We saw it climb as high as 57.5 basis points overnight. That prompted the BOJ to do a second day of unscheduled bond purchases. So we did come off the highs of the session, but still we're north of that 0.5 percentage point cap, Matt. Right now, the 10-year JGB yield trading at 51 basis points.
Yeah, watching that very closely as the BOJ continues to make unscheduled purchases, and I'm sure we'll talk about that throughout the program. S&P futures are unchanged this morning. We are going to get some more data later today, including the University of Michigan sentiment data that has occasionally proven to be market moving. The U.S. 10-year yield is rising a little bit, but it's still relatively low compared to where we've seen it the last few weeks and months. 344.67, the level on the 10-year. And then gold is relatively high. It continues its climb, now over 1,900 a troy ounce at 1904.91. So gold gaining just about 0.4%, but getting through that big round number of 1,900. And speaking of continuing to climb, Bitcoin is almost at $19,000 a piece right now, $18,922 where Bitcoin is trading, also up about 0.5% right now. So that march higher continues for the digital currency or commodity, Anna, depending on how you feel like defining it. What do you see in Europe?
Yes. Yeah, it feels like Bitcoin may be moving in tandem with European risk assets. That would be an odd one, but that's what we've got right now. This is European stocks up around 0.5%. So we're flat on US futures, looking to factor in a little bit of that post-CPI strength in US stocks, yesterday. Although, of course, European markets did have a chance to react to that yesterday. But it is that narrative that's been with us all week about the moderation in inflation that seems to be pushing European stocks higher. And I put the European stocks 600 in again, just to underline this point. We're up by 0.6% today. Another day of outperformance from European assets. And it is a fact now that we're heading towards the best performing, best start to the year, best 2-week start to the year for European assets, European stocks ever. So that does seem to be something of note and something we've talked about on this programme a number of times. Not so for European autos, perhaps. That sector down by just over 2%. We've heard that Tesla is reducing the price of some of its vehicles in various markets globally. As a result, that increases the competition for the European automakers. The euro is pretty flat, but 108.46, so slowly making progress from that parity level that we talked about a lot last year. That was a time when we saw real strength in the dollar, of course. And this really tying in with some German data today. Might we not have seen contraction in the fourth quarter in the German economy? That's the question today. It looks more like it was stagnation, not contraction. I mean, stagnation isn't great, but it's better than contracting, given all the headwinds that were being thrown at the German economy, like finding entirely new sources of energy. And the pound at 122.36. We've had data out on the UK economy today as well, suggesting a better outcome for the UK in the fourth quarter than had been anticipated. The November data certainly points in that direction. It seems that the World Cup got people out of their homes and into pubs, and that obviously, in a very British fashion, seems to benefit the economy. Now, sticking with UK assets, earlier on Bloomberg, we spoke with Stephen Gallo, the head of European FX strategy at BMO Capital Markets. He explained why he's currently constructive on the pound.
But the optimistic case is that inflation moderates both in the UK and at the global level, stays moderate, volatility doesn't pick up substantially inflation, and the Bank of England is able to pivot, not necessarily cut rates by the end of 2023, but start taking a much more growth-friendly approach to how it sets policy. Now, if that's the case, despite the fact that it would mean the spectrum of sterling yields will drop, we actually think that's bullish for sterling. It's bullish for risk assets, it's bullish for UK assets, and it probably will support the pound.
Stephen Gallo with his view on the UK. Bloomberg's Valerie Teitel has a closer look at some of the data we got from the UK today. Take us through it then, Valerie.
Yeah, so it's good news, Anna. The UK may not be in a recession, and it may not even fall into a contraction in the fourth quarter of 2022. This is now the second print in a row that's become above estimates. Today's print hit positive 0.1 versus expectations for a 0.2 decline. And it was driven mostly by the services sector, which, as we know, makes up a very large part of the UK economy. Nearly 80% of us here are employed in the services sector here in the UK. You know, as you mentioned before, possibly because of all the spending at the pubs during the World Cup, that definitely helped this sector out. But you know, if you look at what the ONS said about the fourth quarter, we'd probably need to see a 0.5% contraction in December in order to get a fourth quarter decline. That's unlikely to happen. We've had some good earnings releases from retailers here in the UK this week, especially Next, one of the biggest ones here in the UK, upgrading their profit forecast. It does seem like the consumer is holding up well here in the UK in December. But the bad news is the Bank of England themselves was forecasting a contraction in the fourth quarter. And if that doesn't come to fruition, possibly the labor market remains too tight and they might need to raise rates higher than expected. The 2023 GDP forecast, is the BN survey estimate, is nearly up for a 1% contraction in GDP growth. So the outlook still does look pretty nasty.
Well, Valerie, as we talk about labor markets that are still tight, the labor market is still looking very robust here in the U.S. as well. Even as evidenced by the CPI data we got yesterday, we are seeing those inflationary pressures coming down. Is this all adding up to a greater likelihood that the Fed is actually going to be able to pull off the soft landing?
Hey, Kailey, I'm becoming more and more positive every day that the Fed might be able to pull that off. But the data yesterday really came on the screws. Notably, the only thing running hot was the rent or the shelter components, which Powell has dismissed as a lagging indicator, so we're going to dismiss it too. If we look at these sectors on a 3-month annualized rate, they show substantial progress since the summer. I have here in yellow, this is services excluding shelter, and then core goods here in white. They've seen substantial declines since the summer, which points to the fact that the Fed's rate rises might already be making their impact on the economy and reining in inflation. The market is currently pricing in 25 basis points of a hike for the Fed in their February meeting, and there's now a non-zero probability priced into the front end, Kailey, that could be their last.
Oh, that changed pretty quickly. Valerie, thanks very much. Valerie Teitel there with a look at market expectations as well as the UK economy. Let's get to corporate news. A big pay cut in the works for Tim Cook. Apple is reducing its CEO's compensation by more than 40% to just $49 million this year. Bloomberg Quick Take's Alex Webb joins us now. Alex, how will he survive?
I know, my heart bleeds. Look, they've come under a lot of pressure from shareholder groups like ISS, which suggests that not only is he perhaps being paid too much, but too much of it is not, or I should say, not enough of it is tied to the share performance. So there are two things happening here. The payment itself is decreasing, but a greater proportion of it, 75%, will be tied to the stock. And, if we've seen Apple shares down 25% from their peak last year, you can see what's therefore driving some of this decision-making. Tim Cook perhaps also sending a bit of a signal to other executives about the direction of travel he thinks executive pay should go, because he is doing this voluntarily.
OK, so that's an interesting one in the tech space. Good morning to you, Alex. Also in the tech space, the Chinese government is set to take so-called golden shares in units of a number of tech businesses in China, Alibaba and Tencent amongst them. Now, this is really interesting because just of late, we seem to have heard more conciliatory messages from the Beijing government towards big tech. So how do we read this?
Yes, it's sort of just saying we're going to give you, well, we saw in December that there was a big economic meeting which he signalled, as you suggest, a softening towards tech after the crackdown of the past 2 years or so. This is maybe just a note of caution that, yes, we're going to give you a slightly freer rein than maybe we have done of late, but we still want to keep you within arm's reach and keep you in check. There have been certain crackdowns, not least on some of the leadership within those companies. So having the golden share means the government has a seat at the table when it comes to how these companies are administered.
All right, Alex, thanks so much for joining us. Bloomberg Quick Takes, Alex Webb there talking to us about Apple. Another bank's earnings season is upon us. JP Morgan, Bank America, Citi, and Wells Fargo will all step up to the plate and then some. Sonali Basak, our global finance correspondent, joins us now for what we can expect later this morning. Sonali?
There are a few things. There's some really bad news. Of course, we know that investment banks are expected to be down 50% or more. 4 banks reporting today, including JP Morgan, where those investment banking results are still a very, very big number. Now, trading, on the other hand, remember, some businesses had their best quarters or second best quarters. Rates across the industry were just blowing through the roof. Bank of America has already said that they could have the highest fourth quarter ever when it comes to trading. But there were also some hiccups, remember, in the quarter. Think about $70 million lost at a European high-yield trading desk over at JP Morgan. So some idiosyncratic events to watch out for in terms of how it would affect performance and the numbers at the end of the day. The other thing with JP Morgan in particular is that net interest income could mint another record. But if you look forward, do they still feel those benefits from high rates? At the end of last year, we heard an executive tell an audience at Goldman's financial services conference that certain businesses, mortgages are still going to be under pressure next year. Card could start to moderate. And so do they still get that benefit from net interest income moving forward when we already know that in the fourth quarter, they're probably going to come in a little bit above expectations on net interest income, as well as above expectations on expenses. So some good news expected for JP Morgan. Can that follow through into 2023?
OK, so trading could be OK. M&A, though, looking more challenged, Sonali. What about the very consumer-facing parts of the banking system? I mean, you've mentioned net interest margin and the sort of bread and butter of banking. A resilience of the U.S. consumer, that could be a feature of what we see here.
It certainly will be, and in some ways you'll see it in terms of potential loan growth moving forward. But I think you also really have to keep an eye out here for the provisioning and how much more it could expand into this year. Of course, provisioning happens every quarter, and as things change and deteriorate, there are more added throughout the year. So the expectations are expansions and revisions there. I would also say, how do you grow the businesses? Remember, very recently reported on JP Morgan the issues they've had with the recent acquisition, which was, again, a very, very, very small acquisition when you look at the entire asset base over at JP Morgan. But the idea here being is the way they expanded was this technology acquisition that had questions around the diligence at the end of the day that amounted to lawsuits. Separately, we're looking at Goldman and potential releases here of restatement of earnings before their investor day that is coming up, as well as their earnings that come up next week. And so the consumer business and how they've expanded there and how they continue to mold that business will be a key thing to watch even today, Anna.
All right, Bloomberg, Sonali Basak, thank you so much. And we're going to get more analysis on the banks later on this hour with Allison Williams, Bloomberg Intelligence Senior Global Banks Analyst. Now, another story we have to watch today, more bad news in the world of digital assets. Crypto.com says it has laid off about 20% of its global workforce. That's on top of layoffs in the middle of last year. Plus, U.S. regulators are now suing crypto brokerages Genesis and Gemini for breaking securities rules. This is in regard to the Earn product. So, Matt, you already have Genesis and Gemini, or at least their respective founders, the Winklevoss twins and Barry Silbert, going head-to-head over this issue. Now enter the regulators as well.
Yeah, absolutely. And I think it's interesting that the regulators, that the SEC is suing both Genesis and Gemini together for the Earn program because they work together. They couldn't have functioned without each other. So it's both Cameron Winklevoss and Barry Silbert that are going to be dragged into this lawsuit. And the question is, if the SEC is successful here, do they start to go after other crypto lenders? Because this is something that other companies had been doing, not just these two. It's just that these two were the ones that put down the gates on withdrawals.
Yeah, so what kind of precedent is this going to set? Of course, this is going to be a story we continue to cover each and every Tuesday on Bloomberg Crypto. That's at 1 p.m. New York time, 6 p.m. in London with Matt and I. Now, on the subject of crypto, I do want to point out in pre-market trading today, even though you are seeing Bitcoin prices actually a little bit higher, some crypto stocks are under pressure. Coinbase is down 1.5%. Marathon Digital down by about 1.3%. One stock that continues to rally, though, is Bed Bath & Beyond. Already in the first 4 days of this week, it is up 300% on the week, and those gains are continuing today. That stock up 6% in early hours after reports that it's speaking with potential lenders that would finance the company during bankruptcy, and that could actually result in the sale of some assets. And then finally, I have to point out Tesla as well. This is a very big story this morning, Anna. The stock down about 4.25%. After it says it's going to cut prices across its lineup in the U.S. and some other major European markets, including Germany, France, and the UK. It really underscores the demand issues that Tesla is facing, and they're trying to do more discounting to try to bring that demand back up. The stock, though, heading down this morning, Anna.
Yeah, and that sector, autos here in Europe, by far and away the worst performer in today's session, down by just over 2%, as that very story, Kailey, weighs on sentiment here. When we come back, we'll talk to Kamakshya Trivedi, Goldman Sachs head of global foreign exchange, interest rates, and emerging market strategy. A great person to talk to about a host of themes: the Eurozone growth story, the UK growth story, the BOJ, and what we expect from next week. All of that will be in focus. This is Bloomberg.
Welcome back to Bloomberg Surveillance, the early edition. I'm Matt Miller with Kailey Leinz here in New York. She's back, and Anna Edwards out in London. We are looking at economies that possibly avoided contraction. I know that the German economy, Europe's largest, avoided a contraction, but we'll breeze right by that because we love the UK much more. It also looks to have avoided a contraction in the fourth quarter. And the FTSE has been on absolute fire over the last year compared to most of the other major indexes in the Western world fell. This is a chart that Dan Curtis, our charts producer, put together for us, showing that a large part of the FTSE's gain is down to the currency. For those of you listening in radio, we're looking at a gain in pounds. That's the white line here. But if you look at it in euros, which is the blue line, or dollars, which is the yellow line, it hasn't done nearly as well. Joining us now is Lynn Thomason, Bloomberg Markets editor. And Lynn, this goes back to Brexit, but it just shows that it's better for domestic shareholders than it has been for those out of the UK.
Yeah, absolutely. I mean, I think if you're a dollar-based investor, you're facing that headwind of the weak dollar eating into your returns. But certainly, UK investors will like this very much.
Yes, indeed. And European assets more broadly, to Matt's point, let's broaden it, Lynn, from the UK. We can do that and talk about what's going on in European assets broadly, because actually European stocks as a whole have had their best start to any year ever, if you take the first 2 weeks of this year.
Absolutely. I mean, it's so amazing. I can't think of the last time in my career that people were excited about buying Europe. And it speaks to the broader trend of the U.S. and all those big hot tech shares coming off and people looking, for what to do with their money. And I think all of a sudden boring is beautiful. Europe has lots of, big commodity companies, drug makers that are taking that cash.
Well, and Lynn, Europe is also having better weather than was expected.
Yeah, I think the fact that the gas crisis hasn't been as bad as we all expected is by far the biggest, spark that's driven this rally, and I think adds to this narrative that Europe and the UK is a great place for investors right now.
I mean, it's not just stocks. Stocks has been a focus of our conversations, but also the euro slowly, steadily gaining ground behind the scenes. 108 now.
Amazing, and the pound as well, back to $1.22. And you're also seeing more companies come to market. There's been an absolutely explosion in bond sales. So again, I think Europe is really becoming a big focal point.
Yeah, absolutely. Explosion in corporate and sovereign debt sales here in Europe over the past week. Thanks to Lynn Thomason for joining us with a look at the markets. For more market analysis, check out MLIV Go on your Bloomberg terminal. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Kailey Leinz with Matt Miller in New York and Anna Edwards in London. Now keeping you up to date with news from around the world, here's the first word. President Biden's handling of classified documents erupted into a political crisis with potential legal repercussions. A special counsel has been named to investigate. Meanwhile, the White House has confirmed that a second set of documents was found in a garage storage area in the president's home in Delaware. Bloomberg has learned that more fuel has been added to the U.S. government's case against Microsoft's $69 billion takeover of game maker Activision Blizzard. Alphabet's Google and Nvidia have joined Sony in raising issues with the transaction. The FTC has sued to block the deal. In Alabama and Georgia, violent weather killed at least 7 people. Much of the damage took place in Alabama, where a tornado cut a 20-mile path across 2 rural communities. 6 people were killed and more than 36 homes were damaged or destroyed. And the only child of Elvis Presley has died. Lisa Marie Presley had been rushed to a hospital in Los Angeles on Thursday after suffering a cardiac arrest. She was a singer who earlier this week appeared at Graceland, the mansion where Elvis lived in Memphis, Tennessee. Lisa Marie Presley was 54.
This is Bloomberg Surveillance Early Edition. Here's what you need to know. The UK may avoid a recession for now. Gross national product unexpectedly rose 0.1% in November. Tesla is slashing prices in the US and major European markets to try to reverse a sales slump. The electric car maker cut the cost of its cheapest Model Y by 20%. And big banks dominate today's earnings reports. We will hear from JP Morgan, Bank of America, Wells Fargo and Citigroup. I'm Anna Edwards in London with Matt Miller and Kailey Leinz in New York. And Matt, the focus clearly is going to be on all the earnings out of the banking sector a little bit later on today. We'll see whether US equity markets have further to rally on those dovish expectations that led us quite far, actually, in terms of risk assets in anticipation of the CPI report, which, of course, we got yesterday.
Yeah, and as Kailey points out, it was bang on, and as a result, we had, well, the market didn't really know what to do with that yesterday. I think a lot of people were anticipating a better than expected CPI report. And so initially we fell, and then later we rose. I think we closed around 39.85 or so on the cash trade on the S&P. So just under 4,000. As you can see, futures are right there right now, 4,003. Not a whole lot of movement. We're getting some more data out later today. And of course, the big bank earnings are so important to this market to see if we have lowered the bar enough to beat this quarter. I'm sure we have. U.S. 10-year yields at 345 right now, unchanged, but at a really low level relative to what we've seen the last few weeks. That's good news for risk assets. And then gold, back up over $1,900 a troy ounce. It's not a huge move, only 0.4%, but it's a big round number. And I think it'll get a lot of people's attention. Gold has been in a pretty steady rally mode for the past few months and continues to gain as expectations for the Fed to raise rates slow down a little bit. And indeed, yesterday we had the third Fed speaker in as many days coming out and saying 25 basis points is cool for now. That may indicate what they're going to do on February 1st. So no longer expecting 50, and the market's no longer pricing that. Finally, Bitcoin up over $18,900. It has been on a tear this week after being stuck at 16,000 and change for well over a month. So finally a move to the upside, but it's not really helping in terms of the pre-market movers, Kailey, is it?
Yeah, no, it's not. You're seeing some crypto-related equities actually under pressure today. Also under pressure, Matt, your other favorite subject, automakers. And this really has everything to do with the Tesla story that Anna mentioned, cutting prices by 20% in the U.S. and major European markets, really trying to stimulate demand, which has been lagging as of late. And that is dragging down the stock. It's down about 4% in early hours. And that is also bringing other auto stocks down in sympathy. General Motors, Ford, each down about 2.2 or so percent, as is other EV makers. The likes of Lucid Group and Rivian are under pressure too. Rivian right now down by about 2.25%. So autos across the board in the U.S. are lower, Anna, and I know that is also true in the European session.
Yeah, absolutely. It's interesting how this is a story that's being seen as good for nobody in the auto space, and that certainly is true here. This is auto stocks down by 1.9%, by far and away the worst performing, one of the only negative sectors here in Europe today, and it is, it seems, entirely to do with that Tesla story. If they are more keenly priced, then perhaps that increases the competition for, in particular, the luxury end of the market here in Europe. This is the broader European story, though, which looks different, looks positive, up by 0.6%, and in fact, we've seen the best start to any year for European stocks. So the past 2 weeks have been really strong for European equities, and we know the reasons for some of that. It's for that reason that we've been watching the German data as well. We've got the euro at 108.44. I put that in just to reflect on the German data that we had out today. It looks as if we didn't get contraction in the fourth quarter in Germany, which is an incredible achievement when you think about the headwinds being thrown at that economy to do with trying to find new energy sources and all of the things that go along with that. So if they manage to just quote-unquote stagnate in Germany rather than seek some kind of contraction, that's being taken perhaps by some in the market as a positive sign. The pound is at 122.33. As we mentioned in our headlines, maybe the UK economy didn't contract last quarter either. We got the month of November data for GDP out of the UK, and just like October, that came in better than had been anticipated, and so really raises the spectre of perhaps going into the winter, at least here in Europe, in a better place than many had anticipated, Kailey.
Yeah, so it's interesting to see that maybe the economic damage won't be as severe as anticipated in Europe, in the UK, and potentially here in the US as well, given the data we continually get out that shows inflationary pressures are easing at the same time that the labor market is still hanging in there. So let's discuss that further. Joining us now is Kamakshya Trivedi. He's Goldman Sachs Head of Global Foreign Exchange, Interest Rates, and Emerging Markets Strategy. Kamakshya, for you, have the odds of a soft landing improved materially in recent weeks?
I think they have, absolutely. I think you mentioned some of the data. I think we are making progress on the inflation front. You know, you're seeing that in the price data that we got yesterday, but also more importantly, the revisions to the wage data that we got out of the payrolls report in the US were pretty encouraging. So I think that the odds of a soft landing in the US have gone up. At the same time as we've had some pretty positive growth surprises in the rest of the world. You flagged the fact that Europe is doing, better after the milder winter that we seem to be having, and China's reopening occurring much faster than I think many people expected. I think is also going to be a positive demand shock to the rest of the world. So all in all, yes, it's been a more a combination of news that is, I think, more constructive for global risk sentiment over the past month.
And what does that tell us about where the economy goes then, Kamakshya? Because if we get growth that slows less than expected, if we have a more resilient picture, does that mean that rates stay higher for longer and applies a different kind of headwind?
I think that's correct, although I think the leadership of where the rate pressure comes from might shift. If you think about most of last year, a lot of that came from the US. I think in the near term, the fact that Europe might actually be doing somewhat better, and the ECB has sort of taken on the baton of being the more hawkish central bank might mean that you get more hawkish impulses to global rates coming out of places like Europe, like China, where growth will swing up, and potentially like Japan, where you're seeing the Bank of Japan make some surprise tweaks as well. So yes, I think it's still going to push rates higher, but I think the bearish impulse is going to be in the rest of the world compared to the US.
One of the topics of conversation being thrown around on the Markets Live blog, Kamakshya, today is around, linked to what you were just saying about where the hawkish impulse comes from, is whether we see Eurozone bonds or treasuries doing better in 2023. Which do you think?
Look, I think that in the first part of the year, I think certainly treasuries look more interesting. I think they also look more interesting because, while I think the odds of a soft landing have gone up, I think that recession risks are still probably higher than normal. And in a portfolio context, the hedging value of bonds is certainly sort of better. And so I think in the first part of the year, I think treasuries look better. I think as we go through the year, I think the resilience of the U.S. growth picture is going to come through much much more clearly. We don't think the cuts that are priced into the curve in the second half of the year are going to be delivered, but you probably need to get closer to that point with positive growth for the market to relent on that cut pricing. That's the point at which the Treasury yields might start to move up again.
What do you think we're going to see in terms of economic growth this year? We've it looks like avoided a recession, at least in Germany and the UK in the fourth quarter. Do they go into a recession, the continent and the island nation in 2023?
Look, I think the picture in Europe looks definitely more encouraging, even relative to a month ago. I mean, think of it almost like a positive supply shock. It's not like Europe has discovered new gas, but relative to expectations and relative to seasonal considerations, Europe is coming out of this winter with, higher gas storage and a better growth and inflation mix than elsewhere. I think the additional complication in the UK, which is why we would still be somewhat, more concerned about the UK, is that the increase in mortgage rates has a much bigger impact on disposable income, on consumption in the UK, just given the structure of the housing finance markets in the UK relative to the continent and also relative to the US. And so I think there are still some differences there. We'd be more cautious on the UK. We'd be more cautious on the pound, even from these current levels, relative to the continent, where, we do think that both the momentum of the data, but also the developments that we've learned over this winter actually are quite encouraging.
Is there any concern, Kamakshya, that central banks, and I'm thinking really specifically of the Fed right now, but I suppose it could happen anywhere eventually, slow down too soon? If the Fed just goes 25 February 1st and maybe another 25 or nothing else after that, then we get inflation roaring back and Jerome Powell ends up looking like Arthur Burns. Is that a concern?
Look, I think that given the moderation in inflation and, some of those, occurring at the headline level, but also some of the positive developments at the wage level, a step down in the pace of hikes and the lower rate volatility that we are seeing is probably appropriate. It's still going to be a hard battle to get core inflation down over the course of the year. And, the central banks have been messaging that rates are going to stay higher for longer. The market doesn't quite buy that right now because there is a lot of concern around recession risk. But if, as you say, we don't see that recession, we see the resilience in the economy and core inflation stays sticky, I think you're going to see financial conditions tighten just by taking out of those rate cuts that are in the second half of the year. But I think that is a discussion for later. I think it's fair to say that the growth inflation picture we've got right now is actually pretty constructive and means a slightly longer runway for this constructive price action than we had thought previously.
Kamakshya, if we could just end with one central bank that has kept policy easy, that's the Bank of Japan. We have seen the slight tweak to yield curve control. The market really seems to be pushing the resolve of Kuroda and his team to tweak that further, considering we have seen the 10-year JGB yield breaking above that 50 basis point cap. What is your expectation of what happens there?
Look, I think that, the fact that they have moved, I think has certainly opened up a wider range of possibilities. And I think many investors expect that there will be further moves, next week itself. I also think that the fact that given their move and given the move in Japanese rates that you mentioned, in fact, Japanese swap rates have moved even further, anticipating further increases in and tweaks to the yield curve control framework. The fact that you haven't seen big spillovers from that to the rest of the world, to other global rates markets, is probably gives them some comfort that if they did want to get away from that sort of policy setting, this is probably not the worst time to do it compared to last year when, global core rates were moving much higher, much more rapidly. So I think there's a decent chance that we see more tweaks to their policy framework in the upcoming months.
Okay, Kamakshya, thank you very much. Kamakshya Trivedi of Goldman Sachs, thanks very much for bringing us your views on global markets. Coming up, we'll get to the earnings season. Earnings from JP Morgan, Citi and Wells Fargo are due later today. Lots of banks reporting next week as well. We'll get a preview of what to expect. Plus, one question for bank executives will be how they are managing the build-up of leveraged financing. Today's big story takes a look at how Wall Street's leveraged debt machine is breaking down. It was built up in the era of cheap money. How is it weighing on M&A deals now? Look for that on Bloomberg.com or on the Bloomberg terminal. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. You're looking live at the Principal Room. Coming up later today, an interview with National Economic Council Director Brian Deese. That's at 12 p.m. New York time, 5 p.m. in London. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Matt Miller with Kailey Leinz here in New York. Anna Edwards with us out of London. It's a big day for banks as JP Morgan, Bank of America, Citi, and Wells Fargo kick off Wall Street's earnings season. Fourth quarter results may be overshadowed by the threat of a downturn. Joining us now is Allison Williams, Bloomberg Intelligence Senior Banks Analyst. So, Allison, thanks for getting up early and coming to the studio with us. What's your expectation broadly? I mean, I feel like we've already seen loan loss provisions raised, and the dour mood has kind of turned around a little bit.
So we do think that the banks are going to add to reserves. The recession is the question of the year, but you're not going to see it this quarter. What you're going to see is very strong net interest income growth. I think that continues to be the story. Fees are weak. That's sort of well advertised. Provisions. So the banks will be taking reserves partially due to the weaker economic outlook, but also because of loan growth. We expect credit card to be strong. It's a seasonally strong quarter. The big news that we could get today is related to costs, and that's because there's an element of management judgment there. We know that there's broad cost pressure, but also how much are the banks investing? Hopefully they continue to invest for the long term, but that tends to be the surprise that we get in January. That's the surprise we got last year with a much bigger budget from JP Morgan. This year, we think that that pace of investment might be slowing, but there still are cost pressures.
Well, and that's why we've seen banks like Goldman Sachs doing pretty large cuts in terms of their workforce. I wonder how much of that is going to be in that investment banking side, considering the IPO and deal-making pipeline has been so weak. Is that going to be the story as we look forward to the rest of this year?
I think that could be a story, closer to mid-year. We are going to see cuts at Goldman Sachs, 7%, according to the numbers that we've seen from Bloomberg News. But there's a few unique things going on there. So about 2/3 of those really are outside of the core investment banking and trading business. They've had this consumer strategy. They're pivoting that strategy. They're going to reorganize the business. We expect that we'll hear more details about that at their upcoming Investor Day. But we think for the most part, banks are not going to be making big cuts to investment banking. The pipelines have stayed full, despite the fact that deal activity was down significantly. We think equity fees are down 70% this quarter. Fees are probably half of what they were in 2021. Granted, 2021 was a record for IPOs. But we do think that the investment banks are a little bit hesitant to cut because in mid-2021, when things were so strong, they were scrambling to find bankers. And so where you might see more of an adjustment is the compensation line.
Okay, yes, we certainly saw that war for talent being such a dominant theme a year ago or so, didn't we, Alison? What about, you've referenced some of the themes in investment banking there. What about trading more broadly? You talked about equities and the IPO market, but what about the trading side, maybe in fixed income? Where are we possibly going to see some bright spots?
Fixed income, we expect to be very strong. We think that there's going to be growth of probably 20% compared to a year ago. And we will be looking across some of the competitors. Goldman Sachs and Morgan Stanley, who report next week, we think could have some of the stronger results. But certainly we'll get a read today. JP Morgan and Citigroup, as well as Bank of America, very strong in that business. Wells Fargo growing. So FICC up 20%. Equities closer to flattish. Keep in mind that equities has a tougher comparison to strength a year ago. And within fixed income trading, we're looking for a continuation of the strength in the interest rates business. Also emerging markets. Jefferies had a 70% jump in their business. A lot of that was aided by the emerging market strength.
You mentioned the compensation line. I'm sure a lot of bankers watching are wondering if they don't know already what their bonus is going to look like. Will we get in the earnings reports some kind of foreshadowing of that?
I think we'll have a look. It's not going to be as clean of a look as we'll see next week with Morgan Stanley and Goldman Sachs because the banks today are more diversified. We will look to JP Morgan's corporate investment banking unit to see what the trends there are in terms of compensation. Its revenue is down, so you would expect compensation to be down, but we do think that the cost to compete has not come down as much as you would have thought, given the 50% drop in investment banking fees. It still is competitive out there, and so we're going to be looking for compensation to come down, but we're going to be comparing that to see how that ebbs versus revenue.
All right, a lot to keep track of with the 4 big banks reporting today. So thank you for joining us early on a busy day for you. Allison Williams of Bloomberg Intelligence, we appreciate your time. And coming up later today, we'll be hearing from one of these big bank executives. The CEO of Wells Fargo will be joining Bloomberg Television. That's at 4:30 p.m. in New York. CFO. Thank you, Matt. 9:30 p.m. in London. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Matt Miller with Kailey Leinz here in New York. Anna Edwards with us out of London. The whole band is back together, which is exciting, an exciting way to end the week. Let's also, another exciting story, certainly for consumers, not as much for shareholders. Tesla is slashing prices in the U.S. and major European markets as well after several quarters of disappointing deliveries. The move is dragging down the stock in pre-market trading. Bloomberg's global autos editor, Craig Trudell, joins us now. So, Craig, we saw already big price cuts in China. A lot of people were wondering if that was region-specific, but now we're seeing huge lops off of the tag in the U.S. as well as, well, at least Germany and the U.K. too, right?
Yeah, France as well. It's really looking, more or less like Europe-wide. So, and to your point, Matt, these are not just little trims. These are big reductions. We're talking about, 20% for the Model Y, which is their top model globally. For the Model S and X Plaid, you're seeing huge, decreases and other iterations of those vehicles as well. So, some of this can be chalked up, of course, to wanting to get their vehicles eligible for tax credits in the U.S. But it's not only that, right? This applies to markets where, there aren't any changes in incentives from governments. And it applies to models that, even after these, pretty significant price cuts, they're way above the limits.
What does it mean for rival car producers then, Craig? I was looking at, a breakdown of European stocks today, and autos stands out as by far and away the worst performing sector today. This is really weighing on the sector.
Yeah, I mean, I think we're definitely still in a position of more demand than the industry can meet for electric vehicles, but this doesn't necessarily inspire a ton of confidence about, being able to sustain the pricing power that this industry has been able to over the last, year plus. And, I think we do have to sort of acknowledge that, the last couple of years have been, not at all normal, right? These are companies that are really production constrained. The chip shortage has been a significant issue. And so we've seen, waiting lists for EVs and combustion vehicles as well for some time now.
Just finally, Craig, very quickly, are we going to see more board pressure on Elon Musk, the man himself?
I think we're already hearing a fair amount of that and seeing a fair amount of that, even with shareholders that are big fans of Musk. They want to see more out of Tesla in terms of, what's the bench like and what the succession plan is going forward after the events of the last few months where he's, moved his attention away to Twitter.
Moved his attention, maybe got a little bit distracted. Craig, thank you very much. Bloomberg's Craig Trudell joining us there with latest on the auto sector. That is it for Early Edition. Surveillance is up next. They'll be hearing from Gerard Cassidy, U.S. Bank Equity Strategy Head at RBC Capital Markets. Of course, we're homing in on the U.S. bank earnings. We will get plenty of U.S. banks reporting today. JP Morgan, Bank of America, Wells Fargo and Citi all report today. Next week, Morgan Stanley and Goldman Sachs. So we'll learn a lot about the U.S. banking sector over the next few days. This is Bloomberg.